Can the ABSLI Wealth Aspire Plan offer guaranteed benefits along with market linked returns for a prosperous tomorrow? Let us find out through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what this policy is about. This is a unit-linked life insurance plan. Some of the key features of the policy are: you have the option to select from two plan variants tailored to your aspirations, and you have a choice of various policy terms to fit your needs, and you also have a selection of multiple premium payment terms for convenience, and there is the availability of 4 investment options to match your investment goals, and you have the ability to add top-ups whenever you have extra savings, and there is a facility for partial withdrawals to address emergency fund requirements. So these are some of the key features of the policy, and there are benefits like death benefit, maturity benefit, and guaranteed additions, which will differ based on the plan options you have opted for. And also there are various fund options and investment strategies that you can choose according to your risk profile and your investment goals. And as a unit linked policy, there are also various charges that you need to pay, like miscellaneous charges, premium administration charges, premium poll charges. Like all these charges are significant for a market linked product. So these substantial fees will reduce the net premium invested, impacting your returns. As a result, your final proceeds over the long term period will be affected. If you want to know more about these aspects of the policy in detail, you can refer to the policy brochure. Now let us take a look at the advantages. So some of the advantages are: riders can be added to the base policy, unlimited partial withdrawals from the fund value are allowed at any time after 5 complete policy years, provided the policyholder is at least 18 years old, and under the self-managed option, you can choose to redirect future premiums. So these are some of the advantages. The disadvantages, however, are: policy loans are not permitted under this policy. There is no liquidity available during the first policy years, and the sum assured is inadequate. So now these are some of the drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding about this policy, let us move on to the analysis part of the video, where we are going to analyze the internal rate of return of this policy based on the benefit illustration given in the policy brochure to help us take a informed decision. So here, for calculation purpose, let us assume that a 35-year-old male has purchased this policy with a sum assured of 15 lakhs. The policy term is 15 years and the premium paying term is 10 years with an annual premium of 1.5 lakhs. The policyholder here has selected the classic option. If the policyholder consistently pays off his premiums, he will receive the fund value as a maturity benefit. So according to the example here given in the tabular column, you can see an assumed rate of future investment return is assumed to be 8% per annum. So this rate is not guaranteed and it does not represent the upper or lower limits of potential returns you can get from this policy. This is just for calculation purpose, as this is an ULIP policy involving market linked returns. This is just an assumed return to show you how this policy can perform at an 8% return scenario at an average. So the fund value is projected to be 28.04 lakhs with an IRR of 6% as per the policy's maturity calculator. So this rate of return does not seem proportionate to the risk undertaken. Investors typically aim to generate alpha from equity investments to comfortably outpace inflation over the long term period. However, the potential return of this policy is comparable to that of debt instruments, making it challenging to consider this plan as an equity investment within your portfolio. So as this policy is not giving us the desirable outcome that we need, let us now move on to a comparative analysis, where we are going to explore an alternative strategy in which we are going to invest in insurance and investments separately to see whether it can perform efficiently if invested separately compared to investing in a bundled product like ABSLI policy. Here, from the same metrics we used in the ABSLI policy, we are also going to apply to this comparative scenario just for fair comparison. So here, for life cover purpose, purpose, we have opted for a pure term life insurance policy with a sum assured of 15 lakhs, which cost us 7,100 rupees annually. The policy term is 15 years with a premium paying term of 10 years. The pure term policy here allows you to save 1,42,900 rupees per year compared to the 1,50,000 premium you paid for the ABSLI policy, which here could then be invested. So the surplus here could be invested. So depending on your risk appetite, you could choose either equity, which is a high risk instrument, or debt, which is a low risk investment. But in this scenario, for a more fair comparison, we have selected an ELSS fund for investment. So the fund value at the end of 15 years is 49.49 lakhs. So these maturity proceeds are subjected to capital gains tax, resulting in a post-tax value of 45.25 lakhs. The IRR for the ELSS investment combined with the pure term life insurance policy is 10.65% post-tax return. So if you want to know how the ELSS tax is calculated, here we do have a small tabular column presented on the screen for your easy reference, which you can pause and see. So these returns are significantly superior to those of the ABSLI policy. They are higher than the inflation rate, thereby accelerating your wealth accumulation over the long run. So what we can understand is that splitting the insurance and investment always yields you better results. So what is the final verdict? Is investing in the ABSLI Wealth Aspire plan worth it or not? This policy offers a variety of fund options and investment strategies to choose from based on personal preferences. However, these options do not add significant value because the potential returns are subpar for a long-term investment. The main reason for the low returns is the high charges, and it also has a high agent commission. So any market-related instrument should help accumulate wealth over the long-term period, but this policy falls short in this regard. Additionally, the sum assured is inadequate, so these two aspects makes this policy unsuitable for your investment portfolio. Your equity investment portfolio requires higher yielding products to achieve your goals. Therefore, it is better to opt for a pure term policy for adequate life cover and build an investment portfolio based on your risk appetite, life goals, and time horizon. Never combine insurance and investment, because investing separately would give you better outcome compared to investing in a bundled product like ABSLI policy, as seen in the example in the video itself.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.